Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Welcome to the Deep Dive, where we take a stack of the latest articles, research, and insights and extract the most important nuggets of knowledge for you.
Yes. Today we're plunging into the crucial insights you need to stay well informed about the global economy, the shifting sands of trade, and the ever-evolving tech landscape.
We've gathered comprehensive reports from Reuters, in-depth analyses from CNBC, Bloomberg, Yahoo Finance, and even CNN, all published this week.
And our mission in this deep dive is really to unpack what's truly significant here, helping you understand not just what's happening, but critically, why it matters for you.
So what does this all mean for markets, businesses, and maybe even your own wallet? Let's unpack this.
Okay, let's kick things off with the big picture. Global interest rates.
Right.
The articles we've been digging into, they really highlight a significant trend. The pace of central bank rate cuts, well, it's clearly slowing down. Yeah, definitely seeing that. We're seeing the European Central Bank nearing the end of its easing cycle, and the U.S. Federal Reserve is staying notably cautious.
And what's particularly striking is how interconnected these decisions seem, yet, well, they're also diverging quite a bit.
Exactly. The Reuters report specifically noted the Fed's hawkish tone this Wednesday, signaling a preference for tighter policy.
Right, leaning against cut.
Exactly, holding rates steady. And this move, it lifted the dollar and interestingly seemed to calm some fears that maybe political pressure was eroding central bank independence.
Despite those earlier calls for lower rates.
Precisely.
And you might recall Jim Cramer's take on this from CNBC. He pointed out the Fed is in a really tricky spot because the signals from the economy are just so mixed.
Yeah, he put it pretty bluntly, didn't he?
He did. He said, and I'm quoting here, the backdrop's just too darned mixed for the Fed to take action. He also highlighted how Fed Chair Jerome Powell acknowledged tariffs are impacting prices.
But wasn't sure about the overall inflation effect.
Exactly. He expressed uncertainty there, warning about potentially more persistent inflationary changes down the line.
Which leads us to that critical question. What's really behind the Fed's reluctance? I mean, why hold back?
Well, historically, like Cramer suggested, you've got a strong labor market, pretty healthy GDP growth.
So cutting rates seems, well, maybe unreasonable from that perspective.
Right. And companies, for now anyway, seem to be absorbing those tariff costs.
But then there's the counter-argument, isn't there? Especially when you look at housing costs.
Oh, definitely. The intractable price of housing, as they called it. It just won't come down.
Plus, consumer spending signals have been a bit shaky. Some disappointments from big household names.
Though offset by strong performers like Visa and Starbucks.
Right, so it's a real balancing act for the Fed. Very mixed signals.
And our sources, looking at Reuters and CNBC again, they indicate investors were pretty discouraged.
Understandably.
Because the Fed didn't even hint at future rate cuts. Markets are now pricing in less than a 50% chance of a cut, even by September.
So, zooming out to that global scene, what we're seeing is kind of a post-synchronization era for monetary policy.
Meaning everyone's not moving together anymore?
Exactly. Reuters detailed where 10 major central banks stand, and it's a real mosaic of different pressures and responses.
Okay.
Many central banks, particularly in Europe, seem near the end of their easing cycles, their period of lowering rates, mainly due to that sticky inflation.
Still fighting inflation.
But others are still cutting. Australia, for instance, looks likely to cut next month after some slowing inflation data came in.
Okay.
And Norway actually made its first cut since 2020 just last month.
Interesting.
And then you have the real outlier, Japan.
Right. The only major one hiking rates.
The sole major central bank in hiking mode. They're raising rates, revising inflation forecasts upward, and seem confident about resuming hikes this year.
Wow.
So it really highlights this global economy that's no longer moving in lockstep. Makes broad predictions much harder.
So for you, our listener, the takeaway here is the Fed stance, well, it directly impacts borrowing costs, mortgages, loans, everything.
And this increasingly fragmented global outlook shapes how attractive different investments might look, as central banks diverge or converge in often unpredictable ways.
Okay, let's pivot then. Let's talk about tariffs, a topic that just keeps dominating the headlines.
It really does. And tomorrow, August 1st, that's a major deadline for President Trump's new tariffs.
Right. Our sources, including multiple reports from CNBC and Bloomberg, they paint this picture of really intense last-minute negotiations.
And some quite surprising decisions coming out of it.
So a crucial question here is, what's the underlying strategy? What's driving these decisions?
Well, the CNBC Daily Open article suggested something interesting. that White House trade policy isn't just about trade balances or, pure economics.
What else then?
It's also fundamentally about who your friends are.
Ah, so geopolitical angle.
Strongly implies that, yeah, trade policy seems tied directly to a country's alliances and political relationships.
That lens certainly helps explain some of the deals we've seen struck. CNBC reported the UK, Vietnam, Indonesia, Philippines, Japan.
They've all reached agreements, got their tariff rates adjusted.
Yeah, Japan and South Korea, for example, both agreed to a 15% tariff rate. But that came with huge U.S. investment commitments, right?
Substantial ones. $550 billion from Japan, $350 billion from South Korea. Big numbers.
And the EU also got a deal, bringing its baseline tariff down to 15% from that threatened 30%.
Although that deal wasn't universally popular. One CNBC article noted some criticism. A French prime minister apparently called it an act of submission.
Oof. Strong words.
But according to CNBC, many key trading partners are still left out in the cold. Canada, Mexico, Australia, and notably India.
India faces a steeper 25% tariff.
That's right, plus some kind of unspecified penalty linked to its military and energy deals with Russia.
So that really underscores that friends first approach you mentioned.
It seems to, yeah. It adds a punitive layer.
So you might be wondering, how does this actually impact major companies on the ground?
Like Apple in India, for example.
Exactly. One Reuters report clarifies that even with that 25% tariff on Indian goods, Apple's iPhone manufacturing plans there probably won't be significantly disrupted.
Why not?
Well, India is still seen as a cost-competitive hub, and Apple seems prepared to just absorb the higher costs for iPhones sold in the U.S. rather than slam the brakes on its India expansion.
So companies are adapting, maybe finding workarounds, rather than just being completely deterred.
It appears so. But what really stands out from Bloomberg's reporting is just how unpredictable this policy can be.
Like the copper tariffs.
Exactly. Trump surprised markets, slapped 50% tariffs on copper imports.
But then exempted refined metals, which are the most widely traded form.
Right. Makes you scratch your head. And this triggered a record plunge for U.S. copper prices, caused massive disruption in global trade flows, wiped out previous premiums.
Bloomberg called it a white-knuckle approach to trade policy.
Apt description. They also clarified, though, that semi-finished products like pipes and wires are subject to the 50% tariff, just not the raw materials or the refined metal.
So very specific and seemingly quite sudden changes.
And for you, the consumer, something else to be aware of, those tariffs on low-value de minimis shipments.
The small packages under $800, often from online orders.
Yep. Those will also apply starting August 29th, so that could potentially raise costs on things you buy directly from overseas.
In this whole dynamic situation, it's also raising fundamental legal questions, isn't it?
Absolutely. Our sources, including Yahoo Finance, confirm there's a legal battle brewing.
Over the president's authority to do this.
Precisely. A federal appeals court panel in D.C. is reviewing a case challenging whether the president can impose such wide-ranging tariffs without explicit congressional approval, citing the International Economic Emergency Powers Act, the IEPA.
And that case is likely heading to the Supreme Court.
Expected to, yes. Which means the legal ground could remain shaky well into next year.
So these tariffs are clearly reshaping global trade, supply chains. A lot of moving parts.
They really are. But what's their tangible impact closer to home? Our next segment looks at how this policy uncertainty seems to be directly affecting the U.S. job market.
Creating that ripple effect on employment we talked about.
Okay, we've just seen how tariffs are kind of redrawing the global economic map. Now let's switch gears and turn to corporate America, specifically big tech.
Where earnings season has delivered some, frankly, massive surprises.
Yeah, the articles we've reviewed from CNBC and Yahoo Finance show Meta Platforms and Microsoft just absolutely crushing their quarterly expectations.
Sending their stock prices soaring.
And the scale of Microsoft's jump is, well, it's astonishing.
Incredible, really. Its shares jumped enough to push its market cap past $4 trillion.
Wow. Joining NVIDIA in that very exclusive club, according to CNBC.
And this colossal growth, it's overwhelmingly powered by Azure, their cloud computing business.
Right. Revenues jumped by over a third.
Yeah, driving Microsoft's fastest overall revenue growth in more than 3 years. It's crystal clear where the momentum is.
And what about Meta?
Also strong. Stock jumped 12% after beating Q2 expectations. Good advertising revenue, as reported by Yahoo Finance.
But the real story there seems to be their massive bet on AI, isn't it?
Oh, absolutely. Mark Zuckerberg is pushing this huge AI spending blitz extending into 2026. He's saying AI initiatives will mean a higher expense growth rate next year than this year.
They're hiring top talent, investing billions, like that $14.3 billion into Scale AI that CNBC noted.
It's intense spending. And it begs the question, what's the strategic payoff they're aiming for?
Well, Meta's CFO stated that the largest single driver of growth will be infrastructure costs as they scale up everything needed for AI.
And Zuckerberg has this vision, right? Everyone having a personal superintelligence to help achieve goals.
Sounds ambitious. Are investors okay with this level of spending?
It seems so, for now at least. Because Meta is already seeing, quote, greater efficiency and gains across our ad system from the AI investments they've already made.
So they're seeing some returns already.
Exactly. And apparently, their Ray-Ban Meta smart glasses are a surprise hit too, seen as a good potential form factor for AI interaction.
So it's undeniable then. AI is the driving force behind this whole tech resurgence right now.
It really is. Analysts are saying Microsoft's AI investments, things like Copilot software, will truly take off in fiscal 2026.
And other giants like Alphabet are pouring money into AI too, raising their spending forecasts significantly.
Jim Cramer put it on CNBC, we're back to loving tech and just tech.
But it's not all smooth sailing, is it? There are geopolitical headwinds, especially for NVIDIA.
Right, the company providing the essential hardware for this AI boom. Our sources report, via CNBC, that China's Cyberspace Administration is now probing NVIDIA's H20 AI chips.
Probing them for what?
For tracking and security concerns. This is happening even after Washington allowed sales of those chips to resume to China.
So ongoing friction there.
Yeah, NVIDIA is facing requests to clarify potential vulnerabilities, backdoors. And this comes just as U.S. lawmakers are also pushing for mandatory tracking features on advanced chip exports.
It's a really complex dance between innovation, commerce, and national security concerns.
Definitely. But despite these issues, NVIDIA's GPUs, well, they're still fundamental to AI development globally.
And looking at the bigger picture, OpenAI announced it's spearheading one of Europe's biggest data centers, right? In Norway.
That's right. According to CNBC, it's dubbed Stargate, aiming for 100,000 NVIDIA GPUs by the end of 2026.
And running entirely on renewable power.
Yes, which emphasizes Europe's push for what they call sovereign AI, building up their own computing capacity to reduce reliance on other regions.
Okay, so we've just explored the high-flying world of big tech and the AI boom. Now let's bring our focus back, maybe down to earth a bit, to the domestic economy.
Right, back to the ground level.
Well,
And the U.S. job market, well, it appears to be losing some steam.
a CNN report highlighted that July's jobs report, which is due out tomorrow, is actually expected to show a notable slowdown.
Yeah, a significant slowdown. We're looking at an expected net gain of only about 115,000 jobs.
That's a big drop from June's 147,000.
It is. And the unemployment rate is expected to tick up slightly to 4.2% from 4.1%, according to those FactSet consensus estimates CNN cited.
So it really begs the question, what's causing this deceleration?
Well, according to that CNN article, hiring has become, quote, anemic outside of just a few select industries,
And why is that?
largely because businesses are just gripped by uncertainty. And this ties directly back to our earlier discussion on tariffs.
Ah, the connection again.
Exactly. Companies feel they simply can't make confident predictions about the economy when trade policies are constantly shifting. It leads to what the report called a perpetual holding pattern for hiring.
A clear ripple effect from trade policy uncertainty onto the job market.
Definitely. And looking at the wider context, the labor market's showing very little turnover. Fewer job openings, hiring's at a one-year low. The quits rate is below the 5-year average.
People staying put.
It seems like it. Layoff announcements were up a significant 29% in July. And the average time someone stays unemployed is rising too, hitting 23 weeks back in June, also from that CNN report.
So it signals a cooling trend across many different sectors.
It does.
So what does this actually mean for the typical worker out there?
Well, the job gains we are seeing are overwhelmingly concentrated in just a tiny fraction of industries,
Which ones mainly?
primarily healthcare, social assistance, and state and local government. These sectors, which account for less than 15% of all jobs, were apparently responsible for 94% of June's job gains.
94%. Wow.
Yeah, so this points to what the CNN report called the return of the K-shaped economy.
Explain that concept again.
Think of the letter K. One arm slopes upward, the other slopes downward. It highlights this widening economic divide where maybe the have-nots are struggling or treading water, while an upper slice of the haves is driving most of the growth.
A divergence in economic fortunes. Okay, before we wrap things up, let's hit just a couple of other individual company stories that kind of echo these broader themes we've discussed.
Sure. Jim Cramer on CNBC's Lightning Round had some interesting quick takes.
Yeah, he thinks Uber is, quote, going to $200 and suggested buying more.
Optimistic there. And for Micron.
He advised buying a little bit here, but noted the crucial need for DRAM pricing to actually rise before you see significant gains.
So more cautious on Micron.
Seems so. Now, on the downside, Anheuser-Busch InBev, ticker BUD, the beer giant,
Yeah, they slumped over 9%.
they did after reporting weaker than expected sales volumes. Yahoo Finance noted struggles particularly in Brazil and China.
Which really highlights the impact of those regional economic slowdowns and maybe shifting consumer preferences we touched on.
Exactly. And then there's Samsung Electronics chip business, a really interesting point here.
What happened there?
Their Q2 profit saw a drastic drop, and it was attributed significantly to a one-time inventory cost directly resulting from U.S. export controls.
Leading to unsold AI chips in China.
Precisely. So this isn't just a Samsung problem, is it? It starkly illustrates how those geopolitical tensions and trade policies are directly hitting the high-bandwidth memory market.
Reshaping the competitive landscape and affecting that whole AI supply chain we were discussing earlier.
Wow, okay. We have unpacked a tremendous amount today.
We really have.
From the cautious steps of global central banks, the dramatic shifts in trade policy,
To the incredible spending and geopolitical complexities in the AI sector.
and finishing with that nuanced picture of the U.S. job market, it's just so clear that the financial landscape is as dynamic and interconnected as ever.
Indeed. The interplay between these geopolitical decisions, technological advancements, and the core economic indicators, it just means there's always more to learn and consider.
Yeah.
The current climate really demands not just understanding what is happening, but digging into why it's happening and how these forces are, well, reshaping the global economic order.
So for you, our listener, the key takeaway is really how these major headlines from the financial world impact your understanding of the economy and maybe even your own financial well-being. Keeping an eye on these converging trends is pretty essential right now.
And this raises an important question, maybe something for you to consider. As AI continues its rapid ascent and trade policies remain, shall we say, fluid,
That's one word for it.
how might this ongoing dance between technological innovation and geopolitical leverage permanently redefine global supply chains in the coming years? Something to mull over.
A great question to end on. That wraps up our deep dive into today's financial headlines. We'll see you all tomorrow morning with new headlines from major financial magazines.